So, hello guys. Am I audible? Can you hear me? Am I audible, friends? Please respond. Those who are in live, can you hear my voice? Friends, those who are in live, please respond. Let me also check. Video not visible. Please respond. Let me also check. So, everything good, right? Video not visible. Please respond. Let me also check. So, everything good, right? Video visible. Okay, friends. So, let's start with our Super 30 CA Inter Paper 3A, that is income tax law. So, what we are actually planning in this session is we have selected, or myself, I have selected the most important questions, most important 30 questions. Most of the questions are your past exam questions or either RTP questions. So we'll be solving each and every question from different chapters. So our agenda is to complete the entire set of questions or important questions within the limited time span. So in the meanwhile, if you have any doubts regarding the topics or when we solve it, if you have any confusion or points like that, you can actually comment in the, what do you say, chat box. So those who are attending this live, you have to be active. The Without wasting time, let's start with the session, friends. So I'll start with the residential status and scope of total income chapter. Question number 1. So we'll read the question together. Then I'll tell you how to solve these kinds of questions. So starting with the question, Mrs. Roma, an Indian citizen, is a government employee working for Indian government, and she submits the following information for the previous year ending 31st March 2025. So we have planned this Super 30. So before moving on to the question, let me make it very clear. We are actually planned this Super 30 series for your upcoming January 2025 attempt. Okay, 2026 attempt. So the previous year that we are about to discuss will be 2024-25 and the assessment year will be 2025-26, right? So yeah, continuing with the question. So Roma is an Indian citizen and a government employee working for Government of India. So hope you remember there is a section called Section 9. According to Section 9, if you are a government employee and you are a citizen who is working outside India, whatever the amount paid by the government to those citizens who's working outside India shall be deemed to be accrued or rise in India according to Section 9. So this question is totally related to or revolves around Section 9. So the first item, salary income received in Malaysia for services rendered there. So being Roma, an Indian government or an Indian citizen and a government employee, whatever salary paid by the government to Roma will be taxable in the hands of Roma in accordance with Section 9. Hope you remember Section 9, income deemed to be accrued or raised in India. So what they are telling us to compute, determine the gross total income of Roma for assessment day 25-26, ignoring the provisions of 150 BAC on the assumption that she is a resident but not ordinary resident or she is a non-resident. So what we are supposed to answer is, so we'll write this format, particulars, then what if she is ROR, sorry, RNOR, and what if she is NR? That is what they are telling us to compute. Okay, if she is RNOR and if she is NR, how do we compute the taxes? That's what they are asking us to do. So is everything clear, friends? My sound, video, audio, everything perfect? Please respond. They are telling us to compute. Okay, if she is RNOR, so sound, video, audio, everything perfect? Please respond. Yeah. So starting with the first adjustment, what they are telling us is salary income received in Malaysia for services rendered there. So Roma, being a government employee, central government will be paying that salary to Roma, right? So salary payable by central government. So for answering this question, you should know what is section 9. What section 9 says, the following incomes are deemed to be accrued or arised in India. Starting with the first point, if you are an Indian citizen and you are a government employee, whatever salary paid by the government to those government employees who are residing outside India, those salaries shall be deemed to be accrued or arised in India. So, even though Roma renders services in Malaysia, being an Indian government employee, government of India pays her the salary, right? So that salary paid by government of India to Roma outside India shall be deemed to be accrued or raised in India, irrespective of a residential status. That income will be taxable in India, and hence we can say 2 lakhs will be taxable if Roma is ROR or RNOR. So in both ways, whether she is ROR or RNOR, it will be fully taxable in India. Now, from salary, we can claim standard deduction at how much? 50,000 rupees. So that also we are deducting from here. So 50,000 rupees standard deduction we can deduct from the income from salaries. Now, what is the next adjustment? Profit from business carried on in Orissa. So Orissa is in India and she have some, or he or she has some business profits from India. If the business profits are from India, then definitely it is accrued in India and hence it is fully taxable in India. So what we can do is in netting off the salary, that will be 1,50,000 will be the income from the head salary. Here also it will be 1,50,000. That is the income from the head salary. Now, the point number 2 is profit from business in India. Profit from business in India, right? Since it is accrued in India, that profit shall be fully taxable in India. The profit amount will be 80,000. In both status, if it is accrued in India, then it will be fully taxable in India. Moving on to the next point, third one, loss from business carried on in Baroda. Baroda being India, it's a business loss which is accrued in India, and hence we can definitely adjust that business loss with the taxable income in India. So it is both profits as well as losses which is accrued or deemed to be received in India shall be fully considered while computing the total income of a particular person. So since Baroda is in India and she have incurred some losses from business which is in Baroda, we can adjust that loss with the taxable profits. So loss from business in India. And how much is the loss? 20,000 rupees is that loss. So you can definitely adjust that particular loss with the business profits. There is absolutely no problem. That can be definitely adjusted. Then what is next? Profit from business carried on in Paris. So business is in Paris. Income is earned and received in Sydney and business is controlled from Paris. So for a non-resident as well as R and OR, income will be taxable in India only if it is accrued in India or it is first received in India, right? For an R and OR and NR, income will be taxable in India either if it is accrued in India or if it is first received in India. So what we can do is we can take that 42,000 that is not accrued in India because these are profits not received in India and the business is controlled from, sorry, not that. These are income earned in Sydney and the business is controlled from Paris and hence it has no connection in India at all. And hence we can say this 42,000 is not at all taxable in India. It is not accrued in India, not first received in India. So what we can write is business from or business in Sydney or business in Paris. Not taxable, not taxable because not accrued in India, not first received in India. Then, what is next? Loss from business carried on in Canada. Business actually is in Canada. Though profits are not received in India, business is controlled from Dehradun. If business is controlled from Dehradun, if you have an income accrued outside India, due to business control from India or profession set up in India, that income will be taxable in the hands of RNOR. Alright? So, when you determine the scope of total income of RNOR, the act is pretty clear. If you have an income which is accrued outside India, but if it is controlled, that business, if it is controlled from India or profession set up in India, then that particular income shall be deemed to be accrued or arised in India. So what we can do is this loss will be adjusted in the hands of R and OR, not in the hands of NR. So this loss from business controlled from Dehradun. And how much is that loss? 46,000. That particular loss will be adjusted with the R and OR, not with the NR, because it is for an NR, it have to be either accrued in India or received in India. For R and OR, to adjust a particular loss, that particular loss from business, that particular business have to be either accrued in India or first received in India, or if it is a business control or profession set up in India, then also you can adjust that particular loss. Moving on with the next point. Unabsorbed depreciation of business in Canada. Unabsorbed depreciation of business in Canada. So Canadian business, unabsorbed depreciation, you cannot adjust it because it is not accrued in India, not first received in India. So hence you have to ignore that particular loss. And this particular case, unabsorbed loss of business in Canada. So this is related to the Canadian business, right? So Canadian business is actually controlled from Dehradun. That means control from India. And hence what we can do? We can adjust this unabsorbed depreciation in the hands of R and OR, not in the hands of NR. Why? Because even though it is business in Canada, it is technically controlled from Dehradun. That is in India. And hence what we can adjust is unabsorbed depreciation 16,000. You can adjust it with the R and OR, not with the hands of NR. Then what's next? Profit from Indonesia business controlled from Delhi. It's controlled from Delhi, and 60% of the profits deposited in a bank in Indonesia and 40% received in India. And hence this 70,000 shall be fully taxable in the hands of R and OR. 70,000. So what we can write is profit from Indonesia, 70,000 shall be fully taxable in India, and in the hands of NR, only 40% of that profits is first received in India. So 70,000 into 40%, and effectively it will be 28,000 shall be first received in India, and that only will be considered while computing the total income in the hands of NR. So 28,000 will be taxable in the hands of what? NR. These are incomes, okay, not losses. So these are incomes. So we have to add it. Then what is next? Rent from house property situated in Canada, received in Canada, not accrued in India, not first received in India. So you don't have to consider this rent. Rent we can write nil nil. Now you have to total everything up. Okay. So 1,50,000 plus 80,000. So I'll take the calculator from here. So yeah, we'll make use of this calculator. Which all are the figures? 1,50,000 plus 80,000, that's a profit. Then minus 20,000, that's a loss. Then minus 46,000, again a loss. Minus 16,000, another loss. Plus 70,000. So it will be 2,18,000 in the hands of R and OR. 2,18,000 will be taxable in the hands of R and OR. And how about NR? 1,50,000 plus 80,000 minus 20,000 plus 28,000. That will be 2,38,000. So 2,38,000 will be taxable in the hands of NR as well. So this is the final answer to the question. So this question totally revolves around two sections. Which all are the sections? Section 5, that is scope of total income, and section 9, income deemed to be accrued or arised in India. So these are the two sections that we have to consider while solving these kinds of math. So is that clear, friends? Have you got a grip over that respective question? Do you have any doubts? Please post your doubts over here. If you have any doubts, please post your doubts over here. I'll go through each and every doubt and I'll make sure that you have understood that concept. Okay. So if you have any doubts, please post your doubts, friends. Shall we move on to question number 2? Friends, shall we move on to question number 2? Please respond. Right. So we will move on to second question. So before reading second question, I want all of you to read the question. Okay, before we start solving second question, I want all of you to read question number 2. Take 1 or 2 minutes. Just read question number 2. I'll display question number 2 over here. Okay, just go through question number 2. Take 1 or 2 minutes and read question number 2. It is related to residential status, especially deemed resident. That is the concept. Section 6(1)(a). So I want all of you to go through question number 2. So please read question number 2. I hope you have read question number 2. If you don't, please read question number 2. So we'll solve it together, okay? So every question I'll give you 1 or 2 minutes to read that particular question and to understand what they are testing in the question, okay? So in that 1 or 2 minutes, you have to simply read the question. I don't want you to solve the question, not necessary. Just read the question, understand the circumstance, and we'll solve it together, okay? That is the very idea. So Mr. Sarthak, a resident, an individual, and an Indian citizen living abroad, that is in Dubai, a tax haven, since 2008, and never came to India for a single day since then, earned the following income during the previous year 2024-25. So friends, this question is related to deemed residential status. What do you mean by deemed residential status? If you are an Indian citizen residing outside India, okay, and you are having total income from Indian source which is more than 15 lakh, plus you are not paying taxes in any part of the globe due to your residential status. Three things. You have to be an Indian citizen, you are having income from Indian source which is more than 15 lakh, and you are not paying taxes in any part of the globe due to your residential status. If all three conditions are satisfied, you shall be deemed to be a resident in India. That's what section 6(1)(a) states about, right? Now, what they're saying is Sarthak is an Indian citizen living in a tax haven, that's Dubai. He's not paying taxes in Dubai. And now the third thing that you have to check is whether his Indian total income from Indian source is more than 15 lakh or not. And what do you mean by total income from Indian source? Hope you remember from the theory that you have learned. Total income from Indian source means what? That is income either accrued in India. We can write income, or rather, I'll write it in full. Total income from Indian source. 1 second, friends. Give me a second. Let me power on my laptop. It's a small problem. Yeah, right. So we will continue. Okay, fine. So where were we? Total income from Indian sources, right? So total income from Indian source, if it is more than 15 lakh, plus you are a individual who is a citizen of India, plus you are not paying taxes in any country due to your residence. That means you are staying in a tax haven. So the only one thing that you have to check is what is this total income from Indian source. Total income from Indian source means three things. Number one, income accrued in India. Then income first received in India. And the third one, income accrued outside India due to business controlled from India or profession set up in India. So All these are the three things. So what we should do is from the question, we need to identify which all are the items that comes under the definition of total income from Indian source, right? First one, income accrued or realized in Dubai, not taxable in Dubai, being a tax haven. Income accrued or arised in Dubai. This is not total income from Indian source. Income accrued or arised in India. Yes, that is definitely total income from Indian source. Income deemed to accrue or arise in India, that also will form part. Income arising in Dubai from profession set up in India, that also will form part. So 10 plus 8 plus 5, that will be altogether 23 lakh, right? 23 lakh will be the total income for Indian source, which is more than 15 lakh. And hence we can say Mr. Sarthak is a deemed resident according to the circumstances given in the question. So determine the residency status of Sarthak and taxable income for the previous year 24-25, assuming no other income arise during the previous year. So Sarthak is a deemed resident under section 6(1)(a) due to satisfaction of all the three conditions that I've mentioned right now. Now, if he is a deemed resident, then automatically we can say that he is an RNOR. All the deemed residents are always RNOR. Now, if he is an RNOR, which all are the incomes taxable in the hands of Sarthak? That is the point number 2. So, what we can write is, since his total income from Indian source more than 15 lakh, he shall be a deemed resident in India. He shall be what, friends? A deemed resident in India. And he is an RNOR. We can call him as an RNOR because all the deemed residents are always RNOR. Now listen. Now listen. If he is an RNOR, which all are the incomes taxable in his hands? That also we should know. So for now, RNOR, his total income shall be income accrued or arised in Dubai, not taxable in Dubai. So that is not taxable in India. Income accrued or arised in India will be taxable. Income deemed to accrue or arise in India also will be taxable. Income accruing or arising in Dubai due to profession set up in India also will be taxable. So total income shall be 23 lakhs. Total income shall be 23 lakh. How it become 23 lakh? For an RNOR, all the income accrued in India will be taxable. All the income first received in India will be taxable. And all the income accrued outside India due to business controlled or profession set up in India also shall be taxable. Are you all listening? Are you getting what I'm saying? Are you understanding what I'm saying? Please listen. Please reply, my dear friends. Are you all here?